Hey, sweetie, it's Dad. I think it's just easier for me to make a real brief screen sharing video. I opened up that PDF for your retirement, and it looks like it's page 125. If you look at the bottom here, where you can see sort of the breakdown. I'm going to bump this up just a little bit so you can see what I'm looking at now. Here are your choices. You've got bonds, short-term. I think for somebody your age, you're still in your early 30s, you don't have to be too concerned about, allocating money into the bond market. That's, though, your personal choice. If you look at this section called Asset Allocation, Target Retirement Income Portfolios, you've got your target retirement date. Your retirement date, let's just call it... I don't know, 30 to 35 years from now, which would put you at around 2045 to 2050. Somewhere in there would be your retirement target. And if you look, for instance, at the 2050 fund, you can see how they break up. That actually changes. So they will allocate it for you based on how close you are to your retirement date, which isn't a bad thing. There's a lot of management here, though. I don't know exactly what the fees are. That's something that you could look at or look into. I don't know if they talk about the fees. They generally don't in these things. They don't want you to know that they're taking 2% of your contribution or whatever the case might be. It might not be that much. It might be 1 or 2%. It could be more. I doubt that, but something to ask about, because this target retirement fund, that's kind of a no-brainer. In other words, you could give money to the 2050 fund, for instance, and initially you can see 86.5% of it will go into equities, which are stocks, and they appreciate more aggressively. The 10% will go into fixed income. I don't know what that 3.5% will be commodities, and then as it gets further and further along, you can see the ratio for equities is less and less and less, so that 5 years from retirement, it's only 26% in equities and 65% in fixed income. Fixed income are basically bonds. They don't depreciate a whole bunch in value. They can in really high interest rate environments, but for the most part, they're considered a safe and secure investment. They're usually U.S. Treasuries, which is about as good as it can get in terms of safety and security, but you're not getting the appreciation. You know, when the stock market goes up 10 or 12% in a year, if you're getting 3 to 5% in today's environment in bonds, you're doing very well. So there's that. So you could do the no-brainer. I'll call it the no-brainer, which is the Target Retirement Fund 2050. Or you could decide to allocate yourself. They've got the S&P 500 Index Fund, which is essentially the 500 largest corporations in the United States. That is sort of the bellwether. So if you bought into that fund, I'm guessing they're going to do nothing more than buy the S&P 500 ETF or some variation thereof. In other words, your exposure there will be probably 99% correlated to whatever the behavior is in the S&P 500. So this is a good fund for investment. If you're looking at the S&P 500, here's what I would do if I were in your shoes. I would put half in the S&P 500 index fund, and then I would do 10%, 10%, that would be 90%. You could do 60% in the S&P 500 fund, and then do 10% in the mid cap, 10% in the small cap, 10% in the international developed, and 10% in the emerging markets. This Aetna Common Stock Fund, I'm not sure exactly what that is. You could also do 50% S&P 500, then 10%, 10%, 10%, 10%, and then do 10% in the real estate, the real asset index fund, which I'm guessing is primarily real estate. You don't have to get heavily into bonds. In fact, right now, if you look at the 35-year retirement, even their fund only has you about 10% in fixed income. And then as you get older, let's say 10 years from now, you may lighten up on your stocks just a bit and you would liquidate some of these funds or portions thereof, and then roll some of those assets increasingly into a bond index fund. As you get down the road, the bond market will be doing better, I believe, 5 or 10 years from now anyway. But right now, bonds are not such a great investment. So I'm going to summarize here and say I'm going to let you choose. But I think your minimum, if you're going to do the stocks and kind of pick and choose these categories, at least 50% in the S&P 500, and the balance would be divided between the next 4 down the list, from the mid-cap, small-cap, international, developed markets, and emerging markets. There's a little higher risk in the international and emerging, but many of these have done very well over the last decade, and it's good to get involved because many of them will continue to do very well as well. And if you want to put a little bit in the real estate asset or real asset index fund, that's fine. So that's plan A. Plan B is just put all of your eggs in this 2050 fund and leave it alone and just contribute to that. That should do fine as well. The difference between these two is going to be negligible. It's like if plan A is up, 11 or 12% year in, year out, this 2050 fund will be up, I don't know, the same, maybe a little less, maybe a little more, but it's not like your 2050 fund is going to be up 3% in the year and the stock breakdown is going to be up, 15%. You're not going to have a huge divergence between these two. But my guess is they're taking more fees out of their target retirement fund because there's more management involved. But that's just my guess. Now, if you scroll down to the next page, you'll see they have this area about self-directed brokerage account. That's pretty cool. A lot of firms do not have that. And this would eliminate all of your fees, these management fees they hit you with that they're really not telling you about, because it's going to be anywhere from 1 to 3% of your overall portfolio will go out the window every year to management fees. And if you were to do a self-directed brokerage account, you've got to fill out an extra form, but that you could just as easily buy and invest in ETFs, which are very simple. They're stock-oriented instruments. You could buy one, or you could actually buy an ETF that mimics all of these. In fact, there are ETFs. It's a single stock. You could put all of your money in that one ETF. You have ETFs that do mid cap. They have the Russell Small Cap ETF. So those are options where you could probably squeeze out an extra 1, maybe 2% a year. You'd be saving it because you wouldn't be giving it to these fund managers who will be taking it out of your account on a year in, year out basis. And if you wanted to go this route, the self-directed route, I could help you, give you some advice as to what to buy. And once again, you're not playing the markets with this thing. You're basically throwing all of your money into a handful of different instruments that are safe. You're only paying brokerage fees, like $5 to $10 a trade, and you're only going to be making purchases essentially. Once in a while, you might get out of the market if you feel bad about it, but for the most part, you're going to be paying much less if you're self-directed. But that's your call. If that's confusing to you or overwhelming or something you'd rather not deal with, totally fine. You can move back up into these managed funds. Okay, so this is on your PDF document that you send me. I think it's pages 125 and 126, and that's kind of where you see all this stuff. If you have any questions, give me a call. Otherwise, we'll talk soon. Okay, I love you. Bye.